Welcome, Governor, to Global Boardroom. You were here at our first Global Boardroom back in May 2020. We were both remote.
We were.
You had just dropped interest rates to 0.1% and spent £200 billion on QE to solve a problem in the bond market. Since then, we've had inflation go to double digits. We had more QE. You had to rescue the government in 2022 after the mini budget. But yet inflation is now back down at 2.3%. QE is down at 650 billion, having peaked near 900 billion. The assets. I mean, I suppose in some ways you must be sort of 2020 Andrew Bailey would be sort of slightly shocked and horrified what has happened since, but then quite pleased with how it's turned out.
Well, we've certainly seen some things in the meantime. You're absolutely right, Chris, and it's very good to be. Well, it's good to be here together actually this time. But I do remember that first time. I think the thing that I would draw from it so far is, and I think this is a very positive message. So I remember saying, I think near that time originally, that this was, or certainly as it went on, this was one of the big tests, probably the first big test of the whole sort of inflation targeting. Independent central bank regime, if you like, because this was obviously much bigger than things we'd seen before. I mean, obviously, we're very much still engaged and always will be, but I think we can cautiously conclude that I think the regime has worked. I think so much I would put the emphasis on the regime having this, the inflation target, having the nominal anchor, having the independent central bank has done its job. And certainly when we look back now at sort of comparing some of this experience as we are now with history, I think we got getting the benefit of that regime.
What is it that you think that's caused this? Why aren't we in the 70s when we had double-digit inflation, but it has now come down?
Well, the big question for us was always then how much persistence we were going to get, what these sort of so-called second-round effects, how much was it going to get embedded into the domestic economy? And to be honest, it has come down faster than we thought it would. I mean, a year ago, we were saying that inflation today, would be, I don't know, around about 1% higher than it actually is. And that, I think, is a good test of the regime. The regime could never stop these shocks happening. I mean, I wish we could stop wars happening. I wish we could stop pandemics happening, but we can't. The real test for us was what was going to be the follow-on, if you like, this sort of persistence effect. It has been, it is there, by the way, but it has been less than history would tell us.
Now, we've got interest rates in the UK at 4.75%, down 2 quarter points from the peak at 5.25%.
Yeah.
And in the November MPC, Monetary Policy Committee meeting and the Monetary Policy Report, you forecast that inflation would be broadly on track at the 2% target if there were another, let's say, 4 quarter point cuts in the coming year. And this is described as a gradual pace. Is that what households and companies should be expecting, barring any big shock?
Well, as you know, we always condition our what we publish in terms of the projection on market rates, and so as you rightly say, that was effectively the view the market had. We emphasised in that report the word gradual. We've been looking at really sort of a number of potential paths ahead, if you like, and some of them are better than others, if you like. So there's the sort of the good end of the distribution is that this sort of disinflation process is now well embedded. There is still a distance to travel because although inflation came down to target over the summer, we've been saying for a while that particularly as the negative energy effects wore off, we were probably going to go back a bit above target, but nothing like obviously where we've been. But then we thought that the good story is that this disinflation is well embedded, and so inflation will come back to target sustainably. And in that world, we can be less restrictive with rates. There's a sort of middle central view, broadly the same, but we have to lean rather harder in, as it were. And we're talking about the pace at which we cut in this world, by the way, to be clear. But we have to lean a bit harder in. The process will broadly be similar, but we're going to have to create a bit more probably spare capacity in the economy to see it happen. The third one is the less encouraging one, if you like. Actually, that there's been some structural change in the economy. I think sort of the one we talk about quite a bit is, well, have there been changes in the labour market post-COVID? by the way, the labour market's very hard to read at the moment because of the data problems, which doesn't make it any easier. But is there a structural story embedded in there? And if there is, then that has made inflation stickier, and we will have to be again somewhat more restrictive than in either of the other two cases.
And your forecasts were based on the middle of those two. So, roughly, if there's a little bit of persistence, if inflation's a little bit sticky, then maybe something like 4 quarter-point cuts. If it's better than that, you might be able to go faster, and if it's worse than that, you go a bit slower. There's a view that other central banks, other big leading central banks, sort of the ECB and the Fed, might go a bit quicker than the Bank of England. Is that because we've, in some sense, got a bit of a worse inflation problem than other places?
Well, I also can't speak for them. I think there are also obviously different outlooks on the outlook for activity. I think there is also, there's uncertainty everywhere, frankly, and if anything, I would say the level of uncertainty is rising at the moment. Now, I think some of that is domestic and some of that is global. I think in our case, the domestic element is really how particularly companies will react to the national insurance change in the budget. We've laid out a range of options, frankly, some of which would imply greater inflation and some of which would imply less inflation, actually. So there is uncertainty there, and we need to see how the evidence evolves. I've spent a lot of time in the last 2 or 3 weeks talking to business events. I've sometimes asked for a show of hands on the channels, and I find that most hands go up for most channels, which of course is actually fair because they're not mutually exclusive. To be fair, that's not an unreasonable thing. And then I think the global thing is obviously the risk of fragmentation in the world economy.
Let's just take those two in turn. Let's just look at the budget. I suppose the bank's view of the budget was the main effect on inflation and therefore interest rates was actually through the fiscal loosening, the fact that there's more public spending this year than had previously been planned. How much of that do you think's already in? Because things like the pay rises and the costs of asylum, they've been happening all this year.
And of course, we were seeing, as you know, consistent sort of overshoots on the reporting of public sector expenditure. So we could obviously observe that there was something going on there. So that wasn't a surprise at all. And I think it's important to make the point about the budget that there was clearly an issue that had to be dealt with in that sense. There were clearly other issues in the sort of current spending world that have to be dealt with, such as sort of how we're going to approach the NHS. I would also say, of course, that one of the important elements of the budget on that front is the tightening that is embedded in the budget.
There's a lot of that.
And there's a lot of it. Yeah, you're absolutely right, Chris. There's a lot of it embedded in the budget, and obviously that has to happen, as it were. So we look at the whole thing because obviously we're looking at a monetary horizon over 2 to 3 years. So we're very much looking at all of that actually. I think the biggest issue now in the immediate sort of future is the response to the national insurance change. I think that is how companies balance the sort of mixture of prices, wages, level of employment. What is taken on margin is an important judgment for us.
And the national insurance change comes in April. Do you think we'll get a sense of where that's going earlier than that, or we just have to wait?
Well, I think I certainly in all the business events I've done recently, I think it's fair that you have to give companies a chance to absorb this, decide how it affects them, what their strategy is going to be. So I'm not expecting people to put their hand up and say, I've worked it out. So I think it will take a bit of time. But I would imagine, as we go into spring, we'll have a better sense as to where it's heading.
And let's talk about the international issues and the big question about global fragmentation. We saw last week that Donald Trump, the president-elect, said he was going to put large tariffs on America's 2 largest trading partners, Canada and Mexico, and additional tariffs on China. What effect do you think that has? Presumably it lowers global growth, but the inflation effects are a little bit complicated, isn't it?
Oh, they certainly are. The inflation effects are not straightforward at all because it depends. First of all, I think it's important, I've been sort of saying this consistently in the last few weeks. There is the saying and there is the doing, and I think it's important. But the administration is not actually in office at the moment, and I think it's always important to wait for that to happen and see what actually happens, because I'm sure there's more distance to be travelled. But you're right in terms of the inflation impact of tariffs themselves. Clearly, it moves traded prices, but of course, it also depends on how other countries react to them. It depends on how exchange rates react to them as well. So, the effect is not at all straightforward to predict.
And the UK's maybe has more of an inflation, more sensitive to exchange rates than many other countries.
Yeah, it's an open economy in that sense. Now, of course, it's also true to say that more of our trade is connected is services than goods. Obviously, tariffs don't work in the same way in services, though it's also true that some proportion of our services trade is directly linked to goods because it's servicing, real things, as it were. But we are still a country that's got far more of our trade and services. So again, the impact will be different in that sense.
Now, if we could look to the future a bit, you talked about the persistence of inflation and whether you had sort of 3 levels of persistence, and that was the way that you were thinking, or the bank was thinking about it. Is this, or the tariff issue, are these sorts of areas where you'd want to bring in scenarios as recommended by the Ben Bernanke report?
Well, we're working towards that, actually, yes. So we've started with these cases. We spent an awful lot of time talking about just the word case and word scenario, but I think we'll sort of put that to one side for the moment. Yes, and I think one reason why we want to do this, I mean, if you take the illustration of the fan chart that we've traditionally published, we've now got risks on both sides, I think, and the fan chart isn't the best tool because they tend to net off in the fan chart somewhat. So I think scenarios can be more helpful, I think, in telling stories and illustrating sort of risks that can go in different directions. So I think broadly, probably yes, we will try again to develop these cases and to then develop scenarios around whatever happens in the global economy and whatever happens. I think domestically with the budget changes, we can do that more sort of straightforwardly because we're sort of more, the parameters of that are more limited.
You presumably then need to also say what the interest rate consequences of living in these different worlds are, which you haven't quite done yet in your cases or scenarios for inflation persistence.
Well, it's one of the things that we're spending quite a lot of time looking at is how you're right, how we look at that question, because obviously traditionally we've always conditioned our forward look on market curves, the market interest rates. But of course, once you introduce scenarios, then you would have a sort of mismatch then if you said, well, we'll take the scenario and we'll plug the market curve in. I mean,
it's nonsense.
You can, and Chris Giles will then say to us in the press conference, hang on a minute, that's nonsense. No, I mean, that's right. So we've got to think about, exactly what we do about that. So that will be another, it's another thing that we're giving quite a bit of thought to.
And do you see that you'd always have the same scenarios every quarter, or is it a pick and mix affair that you'll think, what are the big risks at the moment? And
I think
the ones we want to
Well, I'll speak personally now, because again, the committee will have to come to a view. I would hope, because I do think they're a tool for telling stories. So I would want to have them sort of focused on the big issues. I don't think doing a sort of, quarter up, quarter down scenario, 0.25% raise in interest rates, 0.25% cut in interest rate scenarios is that interesting, frankly. I think, trying to sort of anchor them in the big issues and therefore being a device by which we can tell stories is helpful. Now, of course, we have to watch the alternative trap, I think, which is if you chop and change so much, then people will say, well, I can't get any continuity with you lot. So we'll have to work out what we do about that. We haven't decided how much, what would we actually publish, of course, as well. But that's another question. I mean, we certainly will publish. I mean, question about what. So there are some big questions out there.
And does the bank have the tools to do this at the moment?
Well, we're building them. So there's a very big program of work going on to modernise the tools as well.
So when can the public or people in the markets expect to see these changes?
Well, Claire Lombardelli sort of set out our current thinking in a speech she made recently, and what we envisage is that we will be sort of updating, periodically, but reasonably often as to what progress. And of course, as I say, there'll be some quite big judgments we'll have to make in there, which we'll want to share and get feedback on, frankly.
You're not being very specific about.
Well, we don't have a date in mind at the moment. Not yet, no.
But is it next 2 years, 4 years?
Oh, I certainly want to see changes, progress in the next 2 years and changes. Yes, no doubt about that. And I say you're already beginning to see some bits of it, emerge in the way we're presenting. So
Now, if we can move on to talk about financial stability.
Yes.
The same issues, global fragmentation, same issues, but this is the other half or side of the bank's work. Sometimes doesn't get the same amount of publicity. But
until things go wrong.
Until things go wrong, and then it gets an enormous amount. So, and obviously we saw that in 2022. Just last week, you published your financial stability report, and we saw lots of people take different things away from it, whether it was house prices, government debt. Banks were pretty stable. That's something everyone took out, that the UK banking system is in a pretty healthy state. Instead of us telling you what you said, why don't you tell us what it is that you're worried about in terms of risks?
Well, a bit of scene setting quickly. I think a number of things have happened in the last 15 years since the financial crisis. We've had substantial re-regulation, particularly in the banking system. I would say obviously a lot of it was necessary. Secondly, and in a way probably to a degree as a consequence, although only to a degree, we've had a shift in the balance of sort of intermediation in the world economy from the banking system to the non-banking system.
I was going to stop you there. When you say the non-banking system,
right?
What do you mean?
Well, you tend to think about sort of asset managers, hedge funds, that world. Actually, private equity, private credit,
pension funds and things. The things that blew up in 2022. The sorts of
often a world where the system is different in the sense that it's more of a world where the firm is operating almost as an agent, if you like, for your money, whereas obviously with the bank it's operating as the principal. It's on their balance sheet to manage. So we've seen that shift. So the non-bank world, this collection of institutions is a much bigger part of the economy and the financial sector than it was. I mean, it was always important, by the way, but it's now bigger. One of the consequences of that is that there is more what I call risk to the financial system as a whole coming out of that sector. Secondly, I think we have to face up to the situation that we can't always assume that the banks can be the conduit for putting liquidity in. If we as the authorities have to step in or we have to change, the support we're providing, it won't necessarily be the case that it will just get there through the banking system. If we put liquidity in, it will find its way.
Can you just paint us, I mean, not to say this is what will happen, but paint a scenario of the sort of crisis that you might be worrying about?
Well, I'll give you one example. There is a lot of focus at the moment on this so-called basis trade, which is a very big sort of, in a sense, exploitation of quite small differences between sort of cash rates and futures rates, and to make large amounts of money in that business, you have to take huge positions. So we sometimes get the nominal positions quoted as, and it's jaw dropping at first sight, and then you think, but we know why that's there. The question we don't know the answer to, which is of course the big question, is if there was a sudden shock.
And prices moved.
Prices moved, and those positions get unwound rapidly. What happens? And put very simply and very crudely, at what point does the system break?
Yeah.
Now we've done this system-wide exploratory scenario, which is is quite unique actually, where we've tried to do what I call a flow test. So the traditional bank stress test is what I call a bit of a stock test, in the sense of you come up with this sort of scenario, bad things happen, as it were. Interest rates rise a lot, and then you test the banks for that scenario, but you test them sort of one by one. In this other world, we really need to a flow test. You still have the shocks. The shocks are there. Bad things happen. We put that into the system, and then we recruited 50 odd firms who were, by the way, they were very keen to be involved. And we said, we're going to give you this scenario. We want you to tell us how you will react to it. We can then in a sense, aggregate your reactions. And by the way, we had sort of hedge funds, we had asset managers, we had banks, we had insurers. We also had bits of the infrastructure involved, like clearinghouses. And we said, we're going to, in a sense, aggregate your reactions and see what gives us it, what breaks, where does the tension arise, and we'll identify the sort of if you like, the sort of points of pressure in the system. And I think it's a fascinating exercise to do, and it's a very important exercise to do because we're trying to identify the points of tension in the system.
And what were they? What did seem to break in your?
So in our markets, I mean, there was an issue around the liquidity of gilt repo, for instance. And so, begs the question: should we? We will now look at with the other relevant authorities. Do we need to improve the infrastructure for? Do we need to clear gilt repo, for instance? Question.
And this was because you had gilt prices.
Yeah,
government bond yields
too much
moving
stuff
a lot,
is trying to go through a market at once. Yeah.
So now there's going to be work to sort of ungun that.
Yeah. The other thing that quite separately we've done is what I might call formalise and be prepared to have facilities that we can use in an emergency for non-banks. It comes back to the point I made about you can't always guarantee in the sort of classical sort of almost Badgett-like sense that if you put liquidity into the banking system, it will just find its way everywhere. We are not, to be very clear, because I get asked this quite often, we're not doing standing facilities for non-banks. That's just
a bank thing.
That's a bank thing. But we felt that when we had to intervene in the LDI situation, we spent lots of nights locked away with whiteboards trying to work out how to do it, that we would actually put this on a more formal footing and say, here's a repo facility that we can do with non-banks, those non-banks that we've got signed up as counterparties, and they will know what we would do in that situation, but it's still up to us to trigger the availability, to judge the severity of it.
Just very recently, the Chancellor has sort of called on regulators, financial regulators, to not necessarily to loosen regulation, but to take account of growth.
Yeah.
How much of a tension do you see there between regulation and safety and growth?
Well, I think growth is important. First of all, I would say there isn't a trade-off between financial stability and growth, and we've had the bad experience of the crisis. We've learned a lot of lessons from that. So there isn't a fundamental trade-off. But of course, there are choices always choices at the margins, as it were. And growth is important. I spent quite a bit of time on this in my recent Mansion House speech, which is, we do have to frankly raise the potential growth rate. It's now well below what it was. Because
there's risks of having very low growth, and these can turn into financial risks as well.
Well, the risk for financial stability, the risk for monetary policy, and the issues for fiscal policy, to name but three, as it were. So it is an important issue, and we at the Bank of England are very supportive of both this government and its predecessor, by the way. Both of them, were very much aware of the issue. So we are looking at at areas in regulation where we can do this, but I think fundamentally we can't countenance the sort of trade-off with financial stability in any fundamental sense. But this is why doing things like the exploratory scenario are important, because I do think, and I think this is true globally, Chris, by the way, it's not just in the UK, I think we're seeing it elsewhere. We're probably, we're beyond now a point where I think the instant response to issues is let's make more rules. I think we have to have this rather more, sort of subtle approach, if you like, of saying we really want to use the tools of surveillance we have to try to hone in on the points of tension, points of stress, points of weakness, and then say, well, what's the answer? Is it to improve the infrastructure? Do we need a rule of some regulatory rule? Do we need to, say, invest in the infrastructure? What do we need to do?
Now, I started by saying that 2020, Andrew Bailey would have been maybe surprised and shocked by what had happened in the interim. You are going to be governor till 2028.
Yes.
What would you like to see? What would the 2028 Andrew Bailey like to look back on and to say, what would success look like? I'm some months over halfway, and I did say to my colleagues, it would be quite nice if the second half was calmer than the first half. Well, we'll see. I hope so. Certainly, I think we have a big agenda for the next, rest of my term. We have an agenda, frankly, on the Bernanke reforms to monetary policy, which, I think Hugh Pillar's made the right point here. This is we've been going with the MPC for quite a long time. This is a once in a generational
time to really look at what we do, how we do it, and change things. We do have an agenda with financial stability because this world outside the banking world is now more important. This is a global agenda, of course. It's not just a UK agenda. We can't solve this on our own, but we are a big part of it because of the importance of the UK as a financial centre. So we've got a big agenda there. We've also got a big agenda, actually, which talked about relatively little in the world of payments, actually, which is very much on the agenda for central banks, and we have an agenda domestically for that. So we have a very, very big agenda in the Bank of England, I have to tell you.
But the key thing I think I'd take away from that is big agenda, lots to do, but hopefully a little bit more stability and less drama maybe than the last 4 years. Andrew Bailey, thank you very much for coming onto the FT Global Boardroom.
Thanks, Chris. It's been very good to be here.